In today's economy, most financial systems are based on interest. This means that whenever you take out a loan, whether it's for a house, a car, or even to start a business, you are required to pay back the amount you borrowed plus an additional percentage. This additional percentage is what we call interest. But what's the fundamental issue with this? Let's break it down. Interest-based lending might seem straightforward, but it has far-reaching implications that can affect individuals, businesses, and even entire economies. Interest is the cost of borrowing money. Essentially, it's the price you pay for the privilege of using someone else's money for a period of time. This cost can vary depending on the amount borrowed, the duration of the loan, and the interest rate set by the lender. When you borrow, you pay back more than you took. Sounds simple, right? But there's a catch. The longer you take to repay the loan, the more interest accumulates, making the total amount you owe significantly higher than the original loan. Over time, the interest accumulates, leading to a growing debt burden. This can be particularly problematic for individuals and businesses that are already struggling financially. The more they borrow, the more they owe, creating a vicious cycle of debt. Imagine borrowing $100 but having to pay back $120. Now imagine if you had to do this repeatedly for various expenses. The debt would quickly add up, making it increasingly difficult to manage your finances. Do that over and over, and you're in a cycle of ever-growing debt. This creates an imbalance. The more you borrow, the more you owe, and the harder it becomes to break free from the cycle. This is not just an individual problem, it affects entire economies. The total debt in the system grows faster than the actual wealth. This means that while people and businesses are accumulating more debt, the overall wealth in the economy is not increasing at the same rate. This disparity can lead to economic instability. Picture a scale tipping heavily to one side with debt outweighing wealth. This imbalance can have serious consequences, including reduced consumer spending, lower investment, and slower economic growth. This is where things get tricky. When the debt burden becomes too heavy, it can lead to defaults and bankruptcies, which can have a ripple effect throughout the economy. Businesses may close, jobs may be lost, and financial markets may become unstable. When debts become unsustainable, it poses systemic risks. This means that the entire financial system can be at risk of collapse. The 2008 financial crisis is a prime example of how unsustainable debt levels can lead to widespread economic turmoil. Imagine a row of dominoes, one labeled debt falls, and soon others labeled banks, businesses, and consumers follow. This domino effect can lead to a chain reaction of financial failures, ultimately resulting in an economic crisis. This domino effect can lead to economic crises. So what's the solution? How can we create a more stable and sustainable financial system that doesn't rely on interest-based lending? Economists argue that alternative systems like equity-based financing could offer more sustainable solutions. In these systems, instead of borrowing money and paying interest, individuals and businesses share ownership and profits. Instead of accumulating debt, these systems share risks and rewards more evenly. This means that if a business succeeds, both the investors and the business owners benefit. If it fails, the losses are also shared, reducing the financial burden on any one party. Interested in learning more? Explore alternative financial systems and their potential benefits. Like, subscribe, share. Join us at abolishinterest@outlook.com.